Good morning, everyone. We commence again our topic financial instruments. Today, I think, is the fourth day. Yes. Let us start. Um, all right. So now, yesterday, if we were to recollect, we did a couple of illustrations to identify whether it is a financial asset or a financial liability. And the last question that we did, I suppose, was illustration 15, conversion into a number of equity instruments equivalent to a fixed value. So we came to the conclusion that for CBA, this will be a financial liability, whereas for RQP, this is going to be a financial asset. Okay, so this was the question that we had done. Then we next move on to another illustration. Okay, come to illustration 18, please. Illustration 18. This is right now page 12.105. So let us have a quick look at this. WC Limited writes an option in favor of GT Limited. Okay, so writes an option, that means sells an option in favor of GT Limited, wherein the holder can purchase issuer's equity instruments. Okay, holder can purchase issuer's equity. Issuer means WC Limited. Okay, at prices that fluctuate in response to the share price of the issuer. As per the terms, if the share price of the issuer is less than 50 per share, the option can be exercised at rupees 40, and if it is more than 50 or equal to 50 per share, option can be exercised at 60 rupees per share. Explain the nature of the financial instrument. Okay. So first thing, this is illustration 18, page 12.105. Okay. So now let us first understand the facts of the question, and then we shall proceed further. Okay. So WC Limited, GT Limited. Okay. WC writes an option. So WC is what we call the issuer of the option. GT Limited is what we call as holder of the option. Okay. Now WC has written an option to GT Limited. And what does the option entitle? The holder can purchase issuer's equity. Issuer is who? WC Limited. So the option entitles to buy equity shares of WC Limited. So for WC Limited, does this become own equity? Answer is yes. This becomes own equity. Is it a derivative? Answer is yes. So if it is a financial, if it has to be a financial liability, it must be variable. It must be variable. Okay. So anyways, let us look at the terms. Okay. Let us look at the terms. That prices that fluctuate. So therefore, there is a fluctuation in the prices. So what is happening is essentially settlement in own equity instruments. But when can this be equity? If it is fixed for fixed. Is it fixed for fixed? No, the prices fluctuate. You can buy the shares according to the price fluctuations is what is mentioned here in own equity instruments for variable price. So if that is the case, what will it be? It will be a financial liability. Absolutely right, Kaushiki. Okay, it will be a financial liability. As far as GT Limited is concerned, is it going to matter whether it is fixed for fixed or variable? The answer is it won't matter, because what GT Limited is getting is equity instruments of another entity. So whether the price is fixed or whether the price is variable, as far as GT Limited is concerned, this instrument is going to be a financial asset. Why a financial asset? You can think of two clauses: contractual right to receive another financial asset. This is the first way you could think of it. Or the second one is, you could also think of it as a contract entered, the second clause, potentially favorable clause. Contract entered on potentially favorable terms. On potentially favorable terms. You can think of it either ways and your answer will be right. Okay, so for GT Limited, it will be a financial asset. For WC Limited, that is the issuer, it will be settlement in own equity instruments for a variable price and therefore a financial liability. Okay, so this is your answer to that question. Now, suppose I turn around the question. Suppose I turn around the question and we say that this is the extra part, equity shares of GT Limited instead of WC, if it is equity shares of GT Limited. What do you think? The remaining facts are the same. The remaining facts are the same. So what is it going to be? Variable price continues. Settlement is in equity shares of GT Limited. Okay. So this is extra. Not there in the question. Just to make you, kind of comfortable with the various options that could happen. Okay. Just kind of getting you people familiar. Yes. Good morning, Namrata. Good morning, Tushar. Good morning. Where is Shriram is not there today. Shriram, Janvi. Oh, she's there. Okay. All right. So for GT, absolutely right. It will amount to settlement in own equity instruments, but at a variable price. I'm talking about the extra part. Okay. The extra part. As far as GT is concerned, it will be settlement in own equity instruments, but the prices are variable. And therefore for GT Limited, this is going to be a financial asset. For WC Limited, it is a financial liability because it is an obligation to deliver another financial asset. So therefore, it will be a financial liability. So there won't be any change in the classification, even if you change the settlement, the equity instruments. You could take it as WC or GT. If it is variable for both of them, then it will be a financial asset and a financial liability. So that is right. So we have done illustration number 18 as well. Okay. So now let us move on. There are three small exceptions to this fixed for fixed. So ideally, if you look at the definition of financial asset or a financial liability, what they have mentioned is where the contract is settled in own equity instruments. If it is a non-derivative, then it should be variable. If it is a derivative, then it should be other than fixed for fixed. That is again variable. Okay, on variable terms. So therefore, this is the typical way we do the thought process. However, there are three exceptions to the fixed for fixed rule. What do you mean fixed for fixed rule? That means even if the price or the number is variable, that point also, it will still be regarded as an equity component and not financial asset or financial liability. So what are those exceptions? Exceptions to variable shares or price settlement. See, ordinarily, what should these be, sir? Ordinarily, these should be financial assets or financial liabilities, but they will still be regarded as equity. So you can write in bracket regarded as equity, regarded as equity and not financial liability. That is the meaning of exceptions. Okay. All right. So let us take a quick look. First one. See, suppose options are given to purchase shares. Just we understand with an example. Options given to purchase shares of an entity. Okay, shares of an entity. Okay. Now in this option, the exercise price is rupees 50. Okay, that means at 50 rupees, you have the option to exercise, or we make it 500. The exercise price is rupees 500 to purchase one share of the company. Okay, the company is issuing the options. Now, suppose actual market price is equal to rupees 800. Okay, on the date of exercise, the actual market price is rupees 800. Okay, you tell me now, think logically, will you exercise this option? Will you exercise this option? You have an option to purchase shares of an entity with an exercise price of 500. On the date of exercise, the actual market price of that share is 800. Will you exercise it or not? Obviously, you will exercise. It is a profitable deal for you. You can buy at 500, sell in the market at 800. You'll make a clean profit of 300. Now, suppose on date of exercise, company issues bonus or stock split, either of the two you call it, in the ratio of 1:1. In the ratio of 1:1. Okay. So on the date of exercise, the company issues bonus or stock split. That means for one share of the company, you will get another bonus share. So normally, if you have tracked the markets, the moment you issue a bonus, the market price gets proportionately adjusted. Therefore, actual market price after bonus is equal to how much? Sir, this is equal to 400. So now look at the story. Your exercise price is 500 and market price after the bonus is 400. Okay. So now you tell me, you can exercise only after the bonus. Okay, that means the bonus was done prior and then the shares became due for exercise. So after the bonus, the price became 400 and now the exercise price is 500. So now you tell me, will you exercise the option at this point? Okay, will you exercise the option now? No, you will not exercise. Obviously, because market price is 400 and exercise price is 500. So this is giving a very unfair advantage to the option holder. Okay, option holder bolega, sir, the option to issue equity shares is always there with the company. So if this is a company shares whose intentions are not good, it will issue options. It will go on issuing options. But at the date of exercise, you will convert the existing shares into a stock split or bonus, and ultimately what will happen is our exercise price remains at 500, whereas the market price goes below exercise price. So we will not be able to exercise the option in this case. So what companies do is they will, in the option contract, they will mention that option price will be adjusted proportionately. Option price will be adjusted proportionately for the purpose of corporate events involving structuring of equity share capital. Example, bonus, stock splits, consolidation, not straight consolidation, shares consolidation, etc. Okay. So option price. So this is the option contract. The option contract looks at it like this. Okay. The option price will say that, see, I am giving you the right to purchase my shares at 500. Okay. But in future, if we come out with any corporate event that restructures my equity capital, either could be a bonus, could be a stock split, could be what you say, a stock consolidation. If any of these events happen, we understand that this will have a direct bearing on the option which is given to you. And therefore, at that point of time, we will pro rata adjust the exercise price for you. So in this case, the option to purchase shares at 500 will therefore change and become 250. If this clause was not written in the contract, it would not become 250. But now this clause is included in the contract, and therefore the exercise price, as Kaushiki rightly mentioned, falls to 250 because now the number of shares in the market double, and therefore your exercise price should become half. And now you tell me, comparing 250 and comparing 400, will you exercise the option now? Will you exercise the option now? Yes? Good morning, Viraj. Good morning. Okay, so now you tell me, will you exercise the option now? Yes. See, if this option of changing the exercise price was not given to you, then what would happen is, it would be unfair to the option holder. वो बोलेगा ये तो मतलब it is like you are getting the thing close to you, but you're not able to enjoy the benefits of it. Okay. So therefore, you have such kind of clauses. So now with a bonus also, you still will think of exercising the option, because for you, the exercise price changes to 250 and actual market price is 400. But now look at the contract. You have the company and you have the option holder. You have the company and you have the option holder. The company is issuing an option to purchase company shares. So can I say settlement is happening in the company's own equity instrument? Answer is yes. But okay, number of options are also fixed. Okay, that means I can that it depends on how much he purchases. He can purchase 10 options, 15 options. So number is fixed. But can I say that exercise price is variable in this case? Yes or no? Exercise price is variable. Yes. So now, can you say that the fixed for fixed test is not met in this case? Can you say that the fixed for fixed test is not met in this case? Answer is yes. But sir, the variability is given only of a protective nature. That means what? It is only to protect in selected events which are within the control of the entity. A corporate restructuring of capital is within the control of the entity. And therefore, it is not something which is actually variable in nature. It is not actually variable in nature. And therefore, if it is not actually variable in nature, these variability, 500 becoming 250, is merely protecting the rights of the investor, of the potential investor, and therefore we cannot really call it as a variability. It is a mere pro rata adjustment. And therefore, in cases of share split, consolidation, etc., you are going to have what we call a variability in the price. In spite of that variability, the shares will be classified as what? The shares will be classified as equity. Is it okay? Are you able to understand? Yes. Are you able to follow? Bolo yaar. Tell me. Are you able to follow? Everyone, Namrata, Janavi, are you able to follow? Yes. So there is a variability in the price, but the variability is in proportion to the restructuring of share capital. So therefore, that variability in price will be ignored as far as classification as equity and not a financial liability is concerned. Okay. Yes, everyone, is it clear? Exercise price is variable. Yes. Classification, if other than restructuring, obviously it will be financial liability. Okay. If the prices are variable other than that. So we have another two conditions where prices are variable and still it will be equity. Apart from these three, there are no other exceptions. You will take it as financial liability. Okay. So is this done, everyone? Any doubts? Yes. Any doubts? First exception came to know. You need to have both the components fixed. You need to have the number of shares as well as price fixed for it to be classified as equity. So that is why we call it as fixed for fixed test. Okay. If your settlement in own equity passes the fixed for fixed test, then it will be regarded as equity. Otherwise, it will be a financial liability or a financial asset, as the case may be. Okay. All right. Done. Janvi, did you follow? So you can just make a quick note of this or take a snapshot of this. Then we shall proceed further. Okay. Let me know whether we can proceed further. Yes. Okay, fine. So that is the first one. Second one, this is, not fixed. I mean, this is not absolutely clear like the first one. It could have certain ambiguity, certain confusions, but nonetheless, we will check. Okay. So variability introduced due to passage of time. Due to passage of time. Due to passage of time. Okay. In case of restructuring of capital, we need to have one component fixed. Normally, the number of shares is going to be fixed only, no? Number of shares will be fixed only. It's only the price that keeps on varying. Okay. So the variability in price by virtue of any restructuring of capital event can be ignored for the purposes of classifying the instrument as a financial liability, and you can instead take it to equity. So typically your number of options will be fixed. Okay. Number of options is going to be fixed. All right. Okay. So now let us move on. Variability introduced due to passage of time. So now, in current scenarios where you have startups, etc., there is normally a variability that is introduced depending on, for example, if you want to invest in a company like Zomato, or you want to invest in a company like Paytm, or you want to invest in a company like, you can take any of the startups. Okay. So the investors who will invest will typically say, I will purchase these many shares, X shares, if your user base crosses 50 lakhs in 1 year. I will invest Y shares if, Y number of shares, if your user base crosses so many numbers. I will invest Z amount if your user base crosses so and so numbers. Okay. So when that is the case, you will have to consider that whether the variability which is introduced, is it due to business cases or is it due to passage of time? So you could have case one. Variability due to business scenarios. You could have case one, business scenarios. Okay. For example, subscribe the investor will say, I will subscribe to 5 crore shares if your user base touches 50 lakhs. User base. It could be anything. It could be profitability also. Okay, it could be profitability also. Or your profit is, let us say, 20 lakhs. Okay, I will subscribe to 7.5 crore shares if the user base touches 100 lakhs or if the profitability touches 50 lakhs. I will subscribe to 10 crore shares if the user base touches 150 lakhs or the profit touches 100 lakhs. So these are the various uncertainties which are there. Now these are purely uncertain. Purely uncertain. Do I have a guarantee of user base? Answer is no. Do I have a guarantee of profitability? Again, the answer is no. So these are purely uncertain. They can be achieved at any point of time. I cannot foresee that. I cannot forecast that. I cannot promise that. And therefore, these cases, if they are dependent on certain business factors, then they would be purely uncertain. And therefore, these would rightly be classified as financial asset or financial liability, as the case may be. Basically, what I want to say is, in this case, it will not be equity instruments. It will not be equity. Okay, but a second case may arise. Now look at this, and this is where it appears to be a little off track. Okay, suppose I will tell that I am going to subscribe 5 crore shares at rupees 12 per share if I do the exercising within 1 year. But I still have faith in you, and therefore I believe you can touch 100 lakh users and 50 lakh profitability. Now these users or profitability is not mentioned in the terms of the contract, but to give the investor an incentive, another option is there wherein I will subscribe to 7 crore share at rupees 14 per share at the end of 2 years. Now see, look at the clause. Here, it is purely based on time. Actual intention is that we know that the investor is waiting for us to meet the profitability or the user base. But in the contract, what is mentioned is, if you are exercising after 2 years, you can exercise 7 crore shares at the rate of rupees 14 per share. Or if you are exercising after 3 years, you can enter into a contract for 10 crore shares at 15 per share if you are willing to subscribe after 3 years. Okay. So now understand, case 1, terms of the contract spoke about user base, profitability only. So therefore, all these cases are uncertain. And because all these cases are uncertain, there is a lot of variability which is involved. That can be seen from the fact that we are taking variable number of shares. The contract entitles you to variable number of shares. And therefore, these options or this contract does not give rise to equity, does not give rise to classification as equity. Okay. But in the second case, if you view it on a standalone basis, it is only because of passage of time that you are getting additional number of shares with a variable price. So after 1 year, if you exercise 5 crores, after 2 years, 7 crores, after 3 years, you can take home 10 crore shares. Okay. So therefore, this is happening only due to passage of time. So can I say variability is due to passage of time? Can I say this? Answer is yes, you can say. Now tell me one thing, passage of time, is it certain or is it uncertain? Passage of time. Is it certain or is it uncertain? I am given an option to acquire 5 crore shares after 1 year, after 2 years 7, after 3 years 10 crore. So what I want you to tell me is passage of time. Is it definitely going to happen or is it not going to happen? It is certain. Definitely it is certain. कुछ मत करो ना, इन्वेस्टर को बोलो don't do anything, just sit and warm your chair. 1 साल बीत जाएगा, 2 years will pass away, 3 years also will pass. And therefore, the variability in this contract is dependent on something which is certain. The variability in this contract is depending on something which is certain. And therefore, it will be regarded as equity, even though number of shares are variable and price also is variable. Okay, you can take it as 7, 6, 5, 2, 1, 0, whatever be the cases, you can take it as any case. But important factor is, oh, not here, sorry. This should not come here. This should be here due to certain event. Okay. All right. Okay. So therefore, if the variability is due to a certain event such as passage of time, then though you have made a variable number of shares or made a variable price, in spite of that, it will be regarded as equity because the variability depends on passage of time, which is going to happen for sure. So you can take any number of shares, any price, but within the time span which is mentioned of exercising the option, then it will be treated as equity. Is it okay? Yes. Are you able to follow? Are you able to follow? So in this case, variability is due to passage of time. Treat as equity and not financial liability. Treat as equity and not financial liability. But if it is dependent on something purely certain, it will be regarded as purely uncertain, will be regarded as financial liability. Have you understood? Yes. Kaushiki, Jahnavi, Namrata, Viraj, Tushar, did you guys follow the second exception? Did you follow the second exception? Yes. All right. Great. Next. Third and the last case. Okay. Third and the last case. Suppose you have issued foreign currency convertible bond. You have issued an FCCB, foreign currency convertible bond. Okay. Example. $1,000 of the bond convertible to 10 shares after 5 years. After 5 years at $100 per share. I'll come to your questions, Jahnavi and Namrata. Okay, I'll come to your questions. Okay, just give me some time. Let me complete this. So example, $1,000 convertible, you have, the entity has purchased an FCCB issued by an Indian company. That FCCB is having a value of $1,000 and it is convertible to 10 shares after 5 years at 100 per share. So this is fixed and this is also fixed. Both of them are fixed. Only thing is what? It is at foreign currency. It is at foreign currency. Now, year 0. That means right now, $1,000, dollars 1,000 at the rate of rupees 80. So how much is it worth in INR terms? Sir, it is worth 80,000. FCCB means foreign currency convertible bonds. Okay, FCCB means foreign currency convertible bonds. So you have issued, suppose Infosys issues foreign currency convertible bonds. Whoever purchases it outside India, at a future date, he will get equity shares of Infosys. He will get equity shares of Infosys. तो उसको हम लोग बोलते हैं foreign currency convertible bonds. For example, he has purchased convertible bond worth 1,000 rupees or worth $1,000. Then each $1,000 worth of FCCB entitles you to 10 shares of Infosys, issued at an option at a price of $100 per share. So इसको हम लोग बोलते हैं FCCB. So suppose in year 0, the bond is worth $1,000. Exchange rate is worth 80. So therefore it comes to 80,000 rupees. When you convert this to equity, convert to equity. How many shares are you going to get? Sir, I am going to get 10 shares. So 10 shares is going to give rise to what amount? Sir, amount will be $1,000 convertible to 10 shares. So 10 shares into $100 into rupees 80. So that gives you how much? 10 into 100, 1,000. Dollars per share. Okay, just a minute. Just a second. Somewhere some figures have gone wrong. Okay, this is fine. Nothing is wrong. Okay. Shares. This is 80,000 rupees. Okay. So a bond of $1,000 is going to get converted into equity shares worth 80,000 rupees. Year 1, the same equity, but the exchange rate is now 82,000. So when you convert to equity, it is going to be worth 82,000. Year 2, the same shares, the same bonds at rupees 85. If you convert to equity, it amounts to 85,000 rupees. See, Infosys has issued FCCB, but Infosys will do the accounting in its books in INR, because Infosys is an Indian company, so the functional currency of Infosys is going to be INR. So Infosys is going to record these FCCBs in the Indian currency. So the Indian currency equivalents map out to 80,000, 82,000, 85,000. Okay. Now understand the convertible nature of these bonds. The convertible nature of these bonds is giving rise to a variable price. Okay. Sir, how do you know variable price? 80,000 divided by 10 shares is 8,000. In second year, 82,000 divided by 10 shares, 8,200. In the third year, 85,000 divided by 10 shares. So year 1, it is going to be rupees, how much? It is going to be rupees 80,000 divided by 10 shares. So that is going to give you rupees 8,000 per share. In the second year, it will be 8,200 per share. And in the third year, it is going to be 8,500 per share. Can you see that there is a variability in the price? Can you see that there is a variability in the price? Yes. He has not yet converted, but if he converts, the price of conversion is going to be 8,000 or 8,200 or 8,500, depending on the number of shares that will be issued. Okay, depending on what are the terms of the option. So now you tell me, is there a variability in the price? Is there a variability in the price? Come on. Year 0, the share price of the convertible bond is going to be 8,000 per share. Year 1, it is going to be 8,200. Year 2, it is going to be 8,500. Is the price per share to be issued going to be different? Is the price per share going to be issued different for each of the years? Don't go into other questions. Just tell me, is the price different? Okay, just a simple question. Is it different? 8,000, 8,200, 8,500. You just tell me, is it different for all the 3 years? Yes, price is different. Now you tell me why it is different. Sir, the difference is because of this. Sir, wo kya hai? What is it? This is the difference because of exchange fluctuation. This is the difference because of exchange fluctuations. Is it okay? Yes or no? If the exchange rate was constant, then would there be a fluctuation? Answer is no. This movement in the price per share is changing solely because of the change in exchange rate. Solely because of the change in exchange rate. But if you look at the original terms of the contract, it is convertible to 10 shares at $100 per share. So is the number of shares fixed? Answer is yes. Is the rate per share fixed? Answer is again fixed. Yes. So therefore, I have a fixed number. I have a fixed price. But that fixed price is denominated in foreign currency. Sir, why foreign currency? It is foreign currency convertible bond. No, where is these people? They are outside India. So वो पैसे क्या transfer करेंगे? They are going to transfer the dollars. And that is why we call it as a foreign currency convertible bond. So therefore, in USD terms, the price is fixed. And in US, in terms of the market outside India, is the conversion number of shares fixed? Answer is again yes. It is only changing when I report it in the financial statements of Infosys because it is on account of exchange rate fluctuations. It is on account of exchange rate fluctuations. And if it is on account of exchange rate fluctuations, though the price of each share appears to be variable, in reality, it is not variable. In reality, it is not variable. It is fixed. It's just that the variability has happened due to currency rates. Okay. So did you understand the 3 reasons or the 3 exceptions? Yes. Obviously, you will be considering Ind AS 21. Okay. So did you understand this part? Did you understand this? Tushar, Janvi, today Sriram is not there. Yes. Did you guys understand? Arey bolo yaar, did you follow? Yes. Okay. All right. Kaushiki, Janvi, did you understand? Kaushiki confirmed. Okay. All right. So therefore, in all these 3 cases, there is a variability in the number or there is a variability in the price. But in spite of that variability, the settlement is happening in entity's own equity instrument. in spite of the variability, it will be regarded as equity. So these are three simple exceptions. Okay. So first exception that we had was due to corporate restructuring, capital changes in the market on account of bonus or stock split or consolidation. If that is the case, then what happens? Then you will be having the variability introduced to protect the option holder. And therefore, in spite of that variability which exists, it will still be regarded as equity. It will still be regarded as equity. Second case, the variability exists on account of passage of time, not related to performance. If we are having variability depending on performance or variability depending on time as well as performance, there is an uncertainty which is introduced. And because of that uncertainty which is introduced, you are going to treat the instrument as a financial, what you can say, on account of that uncertainty, it will be regarded as a financial liability. But if it is for something certain, and that something certain is nothing but passage of time, mere passage of time, if you have, then it will be regarded as what you can say, it will be regarded as equity and not financial liability. Okay. And coming to the last one, FCCB, foreign currency convertible bonds. If the bonds are convertible for a fixed number of shares for a fixed price in foreign currency, it will be regarded as equity. It will be regarded as equity. Though when I convert it into INR, because of exchange rate fluctuations, my rates change. But that does not put me in a position to say that this is not fixed for fixed. It is fixed for fixed. Only thing is that the fixed for fixed happens in another currency. Here it is not visible because currency rates are going on fluctuating. Is it okay? Yes. So all the three questions understood, all the three exceptions understood, everyone. Summarized also. I hope you have noted down also. Yes. Done. All right. Okay. How to understand whether it is due to passage of time or not? It will be given in the question. It will be given straight away in the question. No other factors will be given. If it is given solely due to passage of time, then you can take it as equity. Otherwise, you will have to take it as a financial liability. Okay. All right. So now, two variable preference shares of VT. NKT subscribes to convertible preference shares of VT. Okay. The conversion ratio varies as below. Conversion up to 31st March 20x1, 1 equity share of VT for each preference share held. Conversion up to 30th June, 1.5. Conversion up to 31st December, 2 equity shares. So now you tell me, what is it? Is it variable number? Yes, 1, 1.5, 2. So what is this variability on account of? Is it on account of restructuring event? No. Is it on account of foreign currency convertible bond? No. Is it on account of performance related to business? No. Is it on account of passage of time? If you convert up to 31st March, you get 1. If you convert up to 30th June, you get 1.5. Up to 31st December, you get 2. So this is purely due to passage of time. And am I certain that time will pass? Answer is yes. Time will always pass. Okay. And therefore, the variability in the number of equity instruments for conversion, will you have to take it as a financial liability? Answer is no. You will have to take it as equity. You will have to take it as equity. Is it okay? Yes, absolutely right. Yes, absolutely right. Okay. If I receive own shares at fixed for fixed, that is covered, no, in own shares fixed for fixed when we did this example of WC and JT Limited. Idhar gaya wo? Yes, WC and GT Limited. So the original question was equity shares of WC Limited. Option is given to GT Limited. Okay. So therefore it would be a financial asset. But if it were to be equity shares of GT Limited for a fixed price, then GT Limited is getting its own equity instruments at a fixed price. And if that was the case, it would be regarded as equity. It would be regarded as equity. Is it okay? Yes. So if you read the definition of financial asset, you can see that, okay, that it will be regarded as equity. Is it okay? Yes. All right. In this question, it was variable, I think so. And that is why we have regarded it as financial asset and a financial liability. Okay. Let us move on to the next one. Let us move on to the next one. So now you have all unanimously told me that this is due to passage of time. So that is correct. So it will be regarded as equity. Okay. Please move on to the next question. Illustration 21. On 1st January, HT Limited subscribes to convertible preference shares of RT. ये नोट्स आपको मिल जाएंगे, बट व्हाट आई एम डूइंग इज आई एम जस्ट, यार मेरे नोट्स तो I don't know how much this is going to be useful because most of it is just scribbling and explaining it to you. I call it as scribbling, but हाँ वो scribbling as such नहीं आता है. If you want, I'll be sharing it, but I'm not sure how much it is going to help you. मेरे को क्या, मैं रख के भी क्या करूंगा? Okay. Are you sure? Are you sure, Kaushiki? Look at the definition of equity, of financial asset. A financial asset is any asset that is a contract that will or may be settled in entity's own equity instrument. Okay. So now you are in a position to receive your own equity instruments and is a derivative that will or may be settled other than by exchange. So now you are in a position to receive your own equity for a variable price or a variable quantity. It would be a financial asset. But if you are receiving your own equity at a fixed price for a fixed for a fixed number, then how can it be a financial asset? If you remember, I had explained to you in the initial discussions that where is that definition? Yes. Second. Okay. It was this contract, if I remember correctly. Yes. Investors have invested in the startup and they had invested 4,000. They had invested 4,000. Yes. So now if I have contracted to give them a guaranteed return, obviously I was classifying this 4,000 as equity only because I had to show that only remaining 6,000 are going to be equity instruments in nature. These 4,000s actually exhibit a liability and therefore I debit other equity in my books. Okay. All right. So that is how it is. Okay. तो हो सकता है. Okay, I am not able to otherwise get your question, Kaushiki. Okay, just let me know what it is in detail. You may let me know later on. Okay. All right. Sir, in case the question is of passage of time, say after 4 years on 1 for X1 and X2, it appears that the entity could not operate in the future due to change in law, and it is to be shut down till 20X3. What will be the treatment? See, that is why I said that when we talk about variability due to passage of time, the second exception I mentioned is debatable. The second exception is debatable. Okay. I don't want to get into the debate because there are various cases why it will happen. See, when I'm giving them a variability due to time, this variability is probably introduced based on certain business factors. How do you say, sir? Sir, can you say that I expect that I meet 50 lakhs user base or profitability of 20 lakhs at the end of year 1, and therefore I will structure the contract so that it appears equity. I expect that this is touched in year 2, and therefore I give the variability in terms of passage of time in year 2. I expect this 10 crores in year 3. That means 150 lakh user base and 100 lakhs profitability. And therefore, instead of saying business movements, I will say that it is going to be based on passage of time. Why do you want to show it as a passage of time and not as a business requirement? It could probably be, this is to my understanding, it could probably be that I do not want to burden the startup. I do not want to burden the startup with a heavy liability sitting on its balance sheet. It will end up being over leveraged. And therefore, to protect the interest of the startup, we will, instead of saying it is due to business reasons, if we convert it into time, then the standard gives us an exception. But again, I say that this is going to be purely debatable. Okay. So therefore, clause 2 of the exceptions is you can argue both the ways. Okay. Like you are saying that suppose the business does not decide to continue. Suppose, so when you give that variability due to passage of time, you cannot say company will sit idle and then the number of equity shares will increase. You will say that my profitability will become so much in year 1, so much in year 2, so much in year 3. And basis that you tell shares, if you exercise after 1 year so much, after 2 years so much, after 3 years so much. So now the time factor is essentially linked to the business factor. Only thing is it is not mentioned in the contract, and therefore we are taking a shelter of mere contract. We are taking shelter of merely the letter of the contract. Letter means the words mentioned in the standard, but not the substance. Whenever there is variability due to passage of time, it is generally due to the business performances that you are expecting. Okay. That you are expecting, and therefore when you say after 4 years or in year 2, year 3 the business shuts down, then also by virtue of this definition you cannot change it later. Once you have taken it as equity, the contract remains as such. So the contract continues to be an equity contract, and you cannot say it is a financial asset or a financial liability. Okay, so that is the answer to your question. All right. She wants me to visit the definition of equity. Okay. What is the definition of equity? Okay. Okay. Now, what is Kaushiki's question? See, equity instrument क्या बोलता है? It is a contract that evidences a residual interest. It does not talk anywhere about receiving equity or issuing equity. So that is the first part. So when I have a contract for own equity instruments, if I am receiving my own equity at a fixed price for a fixed amount, it will be equity. There is no requirement that I issue equity shares. Are you able to understand? So please come out of the fact that when we talk about equity instrument, it means the entity will issue equity shares. Okay. So when I talk about fixed for fixed, it could either mean own equity instrument. See, in equity definition, you will not find fixed for fixed. In financial asset definition, financial liability definition, you will find that settlement happens other than fixed for fixed. Now, if that is the case, neither it is a financial asset nor it is a financial liability. Where is it going to come? It is going to come under the category of equity. And then you move on to look at the commentary which is written. It is mentioned there that if the instrument will or may be settled, equity shares. Okay. It is not easy to understand because we have come from a base where equity means equity shares and equity shares are always issued. That is the baggage which we carry, but Ind AS has totally changed the way you view the instruments. Okay. So when it says if the instrument will or may be settled in the issuer's own equity instrument, settled means either I receive my own equity instruments or I issue my own equity instrument. So when we study derivatives in the future, you could also have an option to issue your own equity shares. Okay. You could give an option. So what is an employee stock option plan? You give the option to the employee to take equity shares, at a fixed price. Exercise price is fixed. And then you also have a contract where the number of shares is fixed. So therefore, at the end of the period, if he exercises the option, you have to issue equity shares. You can have opposite also. You give a put option wherein the holder of your instruments has the option to sell it back to you. So this will amount a buyback in the future, and this amounting to a buyback in the future is going to give you a fixed number of your own equity instruments for a fixed price. So that put option will become an equity put option. That put option will become a pure equity derivative in that case. Okay. So if the instrument will or may be settled means received or issuing, anything it could be. Okay. It's not confined to issuing equity shares. You may issue which you are absolutely comfortable with, because still now, as a part of regular accounting, you have seen equity shares being issued. Though you have done a chapter on buyback, it was confined only to buyback. But there could be contracts where I receive the settlement in my own shares. Okay. That means I am buying back my own shares from the market. So that is also covered. So in no way they have said a contract for issuing equity instruments or receiving equity instruments. They are using the word settling in own equity instruments. Settling could mean both receipt as well as issue. Okay. So please go through this particular definition. Okay. Basically, this is opposite of what you find in financial asset and financial liabilities. Opposite of financial asset, financial liabilities. You can see the wordings here. A derivative that will be settled only by the issuer exchanging a fixed amount of cash for a fixed number of its own equity instruments. You tell me, they are talking about settling. Where are they mentioning issue or receipt? Nowhere. They are saying exchange. You can take cash, issue shares, or pay cash, receive your equity instruments. It's just exchange. Okay. So look at the words. A derivative settled by the issuer exchanging fixed amount of cash for fixed number of equity. And now you look at the definition of financial liability. What is it going to be? Financial liability, we will see first. A contract that will be settled in entity's own equity instruments and is a derivative will or may be settled other than by exchange of fixed. Okay, other than by exchange of fixed number of own equity instrument for fixed amount of cash. Okay, so that is how it is going to be worded. Exactly opposite. Okay. The beauty of these three definitions, I again repeat, okay, I can go on and on. The beauty of these three definitions is nowhere have they mentioned a bond is a financial liability. Nowhere have they mentioned equity shares is covered under a specific category. Nowhere have they mentioned an option could be this. Nowhere have they mentioned debtors are trade receivables, loans, advances are financial assets or liabilities. Kahin pe kuch bhi, nowhere any instrument name has been used. It's purely based on characteristics. Okay. So the beauty of this standard is that don't go by the names, don't go by the transactions that you have been subjected to. Just when you approach the standard, wipe out all the knowledge that you have, only ensure that the rules of accounting you know, and then you approach this, you will find it easier to understand. Okay. So anyways, बहुत ज्ञान हो गया, अभी थोड़ा questions करते हैं. Okay, all right. So illustration 20 we did. Illustration 21. HT Limited, coming back to the exceptions of the third exceptions. Okay, on 1st January, HT Limited subscribes to convertible preference shares, convertible in the ratio of 1:1. The terms of the instrument entitle HT Limited to proportionately more equity shares in case of a stock split or bonus issue. Examine whether the financial instrument will be classified as equity. So proportionately ho raha hai in case of stock split or bonus. So therefore it will be equity. Therefore it will be equity. Okay, very simple, no doubt in that. Absolutely clear. So 21 ho gaya. Let us move on to the next one. Okay. Go through the other questions, please. Okay. Till now, is it clear? Kaushiki, your doubt is sorted out? Yes. Okay. Conversion ratio changes. On 1st January, RHT Limited subscribes to convertible preference shares of RDT, convertible as below. Convertible 1:1 if another strategic investor invests at a value of $100 million. Convertible 1.5 if investment happens at 150 million. Convertible at 2:1 if investment is 200 million. Convertible 3:1 if no investment is made within a period of 3 years. If no investment is made within a period of 3 years. Okay. You tell me, what is this going to be? Is it business dependent, or is this passage of time dependent, or is it a combination of both? What do you think? Examine the nature of the instrument. Examine the nature of the instrument. Come on, tell me. Business. It's related to business. Somebody invests. Somebody invests. Somebody invests. No investment. Okay. So all these cases are related to the investment in the business and the business valuations. So therefore, the variability is not related solely to passage of time, and therefore it cannot be regarded as equity. It will be regarded as a financial liability. Okay, it will be regarded as a financial liability. Absolutely right. Okay, so illustration 25 also is done for you. Okay, fair enough. No doubt so far. Okay. Now we come to the most important part of our chapter. Okay, so with this, it ends, you can say, kind of the first part, jahan pe definition of financial asset, liability and equity is done in detail. You will have to do the remaining questions. Okay, I cannot, there is no time for me to do all the questions. Major ones I have touched upon, illustrations I have discussed with you. Okay, so you should be in a position to now try the remaining theoretical questions. Anyways, this is not so important. This is mainly a precursor to your actual accounting. Okay, so now we start with the next set. We now start with the next set, classification of financial instruments. Okay, classification of financial instruments. Okay, very, very important. Two things are very important now: classification of financial instruments, and after the classification, the accounting. In accounting also, typically there are three: one, accounting for financial assets, which is extremely important; accounting for financial liability, which is fairly simple, not very complicated; and last one is accounting for equity, jisme kuch bhi nahi hai. Okay, so out of the classification principles we understand, then when we move on to financial assets, that point of time the accounting for financial assets is of utmost importance. So these two things you will have to ensure that you do it. And then we move on to off-market transactions as a part of this chapter, and convertibles. So what I am starting today and hopefully will continue till Sunday afternoon, this is virtually going to be the most important part of your standard. Okay, the most important one. Till now jo bhi tha, it was merely a theoretical discussion. Okay, now what happens is more focused on your exams. What you can expect, we will do questions, practical questions relating to your examination. Okay, but first we have to understand the classification of instruments. Okay, so the first question that you will ask when a contract is given to you is the first step. Step one, you can note this down along with me, the chart, or you can take a snapshot. The first question that you will always ask is the contract a financial instrument? What is a financial instrument? It gives rise to financial asset for another entity and simultaneously equity or liability for the other entity. Okay, so you have to ask yourself this question. If it is a financial instrument and the answer to that is yes, then you will proceed to ask step number 2. Step number 2. Okay, step 2. Which financial asset? Step 2. Which financial instrument? Is it a financial asset or is it a financial liability or is it equity? And for understanding this, we have taken those definitions for you in detail. 3 full days I have spent, so that now looking at the contract, you should not feel that, sir, mere ko to malum hi nahi financial asset kya hai, equity kya hai, all that I do not know. Ye aap nahi bol sakte. You cannot say that now. Okay, we have discussed at length. So once you identify whether it is a financial asset, financial liability or equity, we move on to the next step. Step 3. That is the accounting. Step 3 is the accounting. Acha, what are the accounting principles? Okay. For financial asset, we have three principles. First one is amortized cost. First one is amortized cost. Second one is fair value through other comprehensive income, FVOCI or FVTOCI. And third category is fair value through profit and loss. Okay, so these are the three methods of accounting which you will be having in the case of financial assets. In the case of financial liabilities, it will be only two, that is amortized cost and FVTPL. Depending on the classification, you will do the recognition. And last one, equity, कुछ भी नहीं है. Okay, valued at initial recognition and thereafter no remeasurement. No remeasurement. So it is like financial asset 3. कौन से है? Amortized cost, fair value through other comprehensive income, and fair value through P&L. Liability, 2 types, amortized cost, FVTPL. Equity, only value at initial recognition and thereafter no remeasurement. Okay, value at initial recognition. Okay, so this is what is the accounting. Now we have to understand, out of all these three, financial asset is most important from your exam perspective. Okay, extremely important. So this is what we are now going to discuss. You had initial recognitions at original cost. You had subsequent recognition at carrying amount, which could be original cost, less depreciation, less impairment. But the term amortized cost, which is there, this is the first time that you are probably hearing it. Okay, so the first step is, once you identify it as a financial instrument, and in that you have identified it is a financial asset, okay, then you will have to perform two tests. You will have to perform two tests. Okay, the tests are, first one is CCFC test or SPPI test. Okay, this is the first test. And after the first test, if you pass the first test, you will perform the second test, which is known as the business model test. Okay, so what is your process? This is only for the financial asset part, which I am explaining to you. Financial liability में कोई test west नहीं है. Okay, this testing is only there for financial asset. You will perform CCFC test, or we call it as SPPI, and then if you pass that test, you do the business model test. The business model test will then give you two results. Depending on those two results, you will have to then arrive at a conclusion as to whether I have to follow amortized cost or FVOCI. Okay, sir, बहुत abbreviation हो गया. क्या है ये CCFC? CCFC stands for contractual cash flows characteristic test. Number one. Sir, what is SPPI? Cash flows solely okay, not cash flows, instruments held solely for the purpose of principal and interest. Okay, so it's these two full forms. Okay, contractual cash flows characteristic test, CCFC, instruments held solely for the purpose of principal and interest, SPPI. Okay. So what does it mean? See, when you enter into a contract, you have a financial asset. Okay. You are now having a contract which is a financial asset for you. So the first question that you have to ask, that the entity has to ask, is what is the purpose behind holding this financial asset? Purpose क्या है? अच्छा, so suppose your purpose is solely to collect the contractual cash flows. Contractual cash flows means what? Contractual cash flows means you have held the amount for collecting the interest thereon and for collecting the principal thereon. You don't have any other objective. You don't have any other objective. For example, entity has surplus cash. बहुत ज्यादा कैश मिलता है. This happens in startups also. When they get a funding, it comes like millions of dollars. तो millions of dollars immediately खर्चे तो नहीं रहेंगे. So what they do is this chunk of amount which they have received, they will put it in fixed deposits. Now, why have they put it in fixed deposits? What is the purpose? Sir, purpose is to keep it somewhere and later on utilize it as and when required. Okay. But is it a financial asset for you? Revisit the definition. It could mean cash or equity instrument of another entity. So is it cash for me? Yes, it's there in my bank account. But it is there in fixed deposit. Okay. But now when you talk about fixed deposit, what do you expect from this financial asset? What are you expecting from fixed deposit? Bolo. What are you expecting? When you make a fixed deposit in a bank, आपका expectations क्या है? What are you expecting? What are you expecting? Tell me. You are expecting only interest, Jahnavi? Principal डूब गया तो डूब गया. Do you want only the interest or do you want interest as well as principal? Do you want interest? Yes. So you expect interest as well as withdrawal facility. That means what are you expecting is the interest as well as the principal. The interest as well as the principal. This is your intent. This is your intent. And the document, the fixed deposit receipt which is issued to you, in the contract, it is mentioned this term deposit is for 6 months or 1 year, whatever it is. The interest thereon is for 7%, 8%, whatever it is. And at the end of that, either the principal gets reinvested along with the interest, or there is an option that the principal with the interest gets credited to your current account or savings account, as the case may be. But your intention is what? By I need interest also, I need principal also. So is it an expectation of the contractual cash flows from the instrument? Answer is yes. And if it is an expectation of contractual cash flows from the instrument and the instrument is giving you those contractual cash flows, can I say that the CCFC test is passed? Can I say that the CCFC test is passed? Yes, because you are holding this to collect interest, to collect principal, और कुछ नहीं चाहिए. You tell the bank, भाई इतना कर लो, मेरे को और इससे ज्यादा कुछ नहीं चाहिए. I only need principal, I only need interest. In other words, जो भी contract में लिखा है, the contractual cash flows only is what I want. The contractual cash flows is only what I want. उससे ज्यादा एक पैसा भी नहीं चाहिए, उससे कम एक पैसा नहीं चाहिए, but इतना जरूर चाहिए. So therefore, we say that the contractual cash flows characteristic test is fulfilled. Or you can say that I had held this instrument only for collecting principal and interest. I don't want anything. And therefore, it passes the SPPI test or the CCFC test. You use the words interchangeably. दोनों एक ही चीज है, but sometimes some people call it CCFC, some people call it SPPI. You can use whatever you want. Are you clear with the test? Yes. Have you understood the test? Yes. Sure. All right. Let us move on to another example. Trade receivables. Trade receivables. Tell me, is trade receivable a financial asset? Yes, it is a contractual right to receive cash. Okay. So now you tell me, is trade receivable meeting the contractual cash flow characteristic test? Can I say that the trade receivable is held solely for collecting principal and interest? Is it meeting the CCFC test? Or is it not meeting the CCFC test? Think and answer. Think and answer. Okay. सोच समझ के जवाब देना. नाम के पीछे मत भागना. Don't think from the name. Think from the substance of the transaction. Is it meeting the CCFC test? My trade receivable. It is a financial asset. There is no doubt in that. So, is it meeting the CCFC test? Okay. Kaushiki said, gave an answer. I'm waiting for the others. Namrata, Janvi, Tushar. Yes, Namrata also gave. Janvi, what do you think, beta? No. Okay. I got 2-3 answers as no, 2-3 answers as yes. Okay. All right. See, when we say solely for the purpose of principal and interest, can there be a case where interest itself does not exist? Can there be a case where interest itself does not exist? हो सकता है ना? A very short period, you can have instruments parked in a very short, for a very short span of time where there is no interest, but you can withdraw the money from that at any point of time. At any point of time. Okay. So when you look at the terms solely for the purpose of principal and interest, don't bring in your mind the fact that ये कोई deposit है, इस deposit पे मुझे interest मिलेगा. Don't approach with that mindset. Approach with the mindset that what are the features of this instrument? Trade receivables. Credit period is 1 month, 30 days. Do you think time value has relevance when the time span is so short? 30 days में क्या होने वाला है आपको? कुछ नहीं होगा. Nothing. Even if you do a discounting, suppose if I tell you do a discounting of all trade receivables whose credit period is 30 days, you will tell me, sir, वो क्यों करना है? 30 days में कौन सा time value बदलेगा? Nothing changes in 30 days. If you are receiving after 1 year, बोलो, we will do the time value. Won't you tell that to me? Of course you will tell, and you should tell that to me. So in a normal trade receivable transaction, will you receive interest? Answer is no. But why don't you receive interest? Because the duration of the credit is so short that time value has no relevance. And because time value has no relevance, can I say that interest is zero? Not because you don't expect it, but because the credit terms are extremely short to warrant recovery of interest. Credit terms are very short to warrant recovery of interest. Number one. Achha, but do you expect the principal, the invoice amount, do you expect that? Sir, obviously, nahi to mera business kaise chalega? So you do expect it. So in terms of the contractual cash flow, can I say that trade receivables meet the CCFC test? Or can I say that trade receivables are held solely for the purpose of principal and interest? Can I say that trade receivables passes the SPPI test? Can I say that trade receivables passes the CCFC test? Can I say that? Can I say that? Yes or no? I'll come to that. I'll come to that. Okay, I'll come to that. Namrata. Yes, it is passing. Okay. There could be instruments jahan pe there is no interest only, but that is because the time limit is so short that interest is not required. Interest is not required. Okay. So you are holding it solely for the purpose of principal and interest. Okay. All right. Fine. 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 Now we move on to the next part. Now we move on to understanding. What should you look when you are answering the question whether the CCFC test is passed or whether the SPPI test is passed? What should you look? You should check whether the instrument meets basic lending arrangement. Whether the instrument meets a basic lending arrangement feature. A basic lending arrangement feature. This is the question that you will have to answer. When you look at a financial asset, the first question that you will be asking is whether the instrument meets a basic lending arrangement. Okay. So what do you mean by basic lending arrangement? Well, you will tell me. If you give money to me, आप में से कोई मुझे पैसे देगा as loan, what do you expect? What do you expect in return? Okay. The contract is, let us say, for 2 years. 2 years you lend money. So what is the basic thing that you would expect in a basic lending arrangement? Okay. That's right. So now, Janvi, more and more things will start getting clear. So you are expecting the principal plus the interest. That is fine. When I talk about interest, what exactly do you expect? How, I mean, if I have to reword the phrase, the interest rate that you expect, suppose 7%, 8%, 10%, वो जो भी rate है, in determining that rate, what are the factors that you will think about? In determining that rate of 8%, 9%, 10%, what are the factors that you expect? Sir, we will look at inflation. Yes or no? We will obviously look at inflation. ऐसा नहीं हो सकता that I lend you without looking at what the inflation is. Otherwise, it will erode my time value of money. So, sir, I will look at the inflation rate. At least that much you will have to compensate me. At least that much you will have to compensate me. Then I got an answer, risk profile. Yes. So therefore, sir, I will look at the credit risk. I will look at the credit risk also. So suppose, sir, inflation rate in the market is 7%. So this is the rate which I am going to definitely look for as a compensation. Second one is you are not what you can say not a corporate entity. So my money is more at risk, and therefore I will put a premium of 4% on credit risk. Okay. The premiums are there. Like for example, AA, AAA, BBB, BBB minus, etc. Ratings are there. So likewise, based on my credit score, we will assign a credit risk rating of 4% to you, which is fine. I'm not saying it's not fine. Okay. And finally, sir, inflation say I'm not getting any profit. Credit risk, I'm not getting any profit, but I have to expect a profit from you, and therefore we apply a reasonable profit margin. We apply a reasonable profit margin. Okay. So now So now these are the three things a basic lender will expect. Okay. So all of you have given the right, I mean, wordings may be a little, what you can say, up and down, but basically you have been able to convey the facts correctly, that you look at inflation, credit risk, and a reasonable profit margin, So let us say that the rate is 2%. Let us say that the rate is 2%. So if you have given the money to me, lent it to me, we will expect a 13% return. We will expect a 13% return of the interest as well as the principal. Okay. So this is what is the first thing that you are going to look at. Okay. Reasonable profit margin of 13% is what you will expect, along with return of principal. If this is only what you are meeting, if this is only what you are expecting, if this is only the purpose behind holding that financial asset, then yes, your instrument passes the CCFC test. Your instrument passes the SPPI test. Okay. Now, let us move on to the next part. I will slightly change this question. Suppose you have an entity, Tata Motors. Tata Motors comes out with an issue of compulsorily convertible debentures. Okay. And you want to invest in the compulsorily convertible debentures. Okay. Now you tell me whether the CCD, compulsorily convertible debentures, whether the CCD meet the requirement of a basic lending arrangement. See, if it is debentures, you are lending money to Tata Motors, right? So now you tell me, a compulsorily convertible debenture, does it meet a basic lending arrangement? If yes, how? Or does it not meet a basic lending arrangement? And how do you say so? Okay, answer this question. Come on, tell me. Does it meet a basic lending arrangement? Okay. All right. So whenever I ask you the question whether the instrument meets a basic lending arrangement, you can have this image in your mind. वो जो village में बैठते हैं ना, money lenders. Okay. Put yourself in a money lender's shoes. Okay. जाओगे उसके पास, money lender के पास. You go to the money lender and say, give me my capital. वो बोलेगा ठीक है, I will give you 1 lakh rupees. You will tell him, I will give you shares of 1 lakh instead of money. Do you think the money lender will give the money to you based on that? Do you think the money lender will give the money to you based on that contract? वो गांव का आदमी है. Okay. He is a person from a village. उसको कुछ नहीं पता. All he has is some ancestral wealth. He is only lending the money, getting the interest, and उस हिसाब से उसका घर चल रहा है. Okay. So now you tell me, do you think the money lender sitting in the village will accept your offer of giving shares in your business to him? No. अरे उसको कुछ नहीं पड़ी है, वो बोलेगा मैं शेयर लेके क्या करूंगा, मैं आपको 1 लाख दूं और बदले में आप मुझे रिटर्न नहीं करोगे, आप मुझे कागज में इक्विटी शेयर्स दे दोगे. व्हाट डू आई डू विद दैट इक्विटी शेयर्स? सो नाउ यू टेल मी, compulsorily convertible debentures, investment in compulsorily convertible debentures, do they meet a basic lending arrangement? And answer to that is no, they don't, because the principal is not coming back to you. The principal is getting settled in equity shares is not a basic lending arrangement. A basic lending arrangement is one where you expect the interest as well as the principal to be repaid back. When your principal is getting converted to equity, वो basic lending arrangement कैसे हो गया? नहीं होता है वो. If you put money on a fixed deposit and then the bank will tell you that I will not repay your FD, I will instead give shares of the bank to you. Is it fine with you? जब आप fixed deposit में पैसे डालोगे, when you put money on a fixed deposit and the bank will tell I will not return the FD, instead I will issue shares of the bank to you, will you expect, will you take it? You will say मेरे को shares नहीं चाहिए आपके बैंक के, I need my money back. And therefore, is it going to be a part of a basic lending arrangement? Answer is no. When Canara Bank gives you a housing loan, can you say that I'll not repay your loan, I will give you shares in my company? Can you say that? Answer is no, you cannot. You can issue shares in a stressed situation, okay, but that comes through restructuring, etc., etc. It's a huge process. वो basic lending arrangement नहीं होता. It is not a basic lending arrangement. In a basic lending arrangement, you expect two things: interest, principal. Principal तो आएगा full amount. Interest calculation is determined based on inflation rate, credit risk, and reasonable profit margin. Nothing less than this, nothing more than this. So compulsorily convertible debentures, when you invest in CCFCs or when you invest in CCD or compulsorily convertible preference shares, these instruments do not meet the requirement of basic lending arrangement. And if they do not meet the requirement of basic lending arrangement, can I say they are not financial assets? Answer is no. ऐसा कहाँ है? You are getting shares in place of those debentures or preference shares. So therefore, they are financial assets. Only thing is, they do not pass the CCFC test or the SPPI test. Is it okay? Yes. Are you able to understand? Yes. When I talk about SPPI test, be very, very, very clear. आपको मिल रहा है क्या? You are getting principal and interest. Nothing else. Means absolutely nothing else. It is a very, very clear, organized definition of the SPPI test. Is it okay? Yes. Have you understood now? Okay. Have you understood? Okay. तो थोड़ा सा और परेशान करते हैं आपको, ये लास्ट परेशानी है. ओके, बिकॉज you know some things are worth troubling. Okay, let us assume that RBI has come out with, you've heard this term, right? Sovereign gold bonds. Sovereign gold bonds. Have you heard this term? Have you heard this term, sovereign gold bonds? Sovereign gold bonds क्या होता है? इंडिया इज अ कंट्री जहां पे गोल्ड के पीछे लोग पागल होते हैं. ओके, हमें तो बस मौके चाहिए गोल्ड के लिए. ओके, शादी, सगाई, वॉट एवर बी द थिंग, कोई somebody is born और कोई फंक्शन है, वॉट एवर इज देयर, वी ऑलवेज वांट टू डिस्प्ले गोल्ड. ओके, सो आरबीआई केम टू नो दिस. बट गोल्ड है, व्हाट इज गोल्ड? यू बाय गोल्ड, कहां रखोगे गोल्ड? You will put it in the bank locker. So basically it is a dead investment for you also, for the government also. Okay, आप gold खरीदोगे, your money is blocked in that gold, and वो गोल्ड जाके लॉकर में बैठ रहा है. So basically what is the gold as an investment is that you put a chunk of your money in the bank locker. ना आपको फायदा, ना गवर्नमेंट को फायदा, किसी को फायदा नहीं. So what the RBI decided is, let us come out with a sovereign gold bond. In sovereign gold bond, what is the terms of the gold bond is, you place the money with RBI. Okay. There is a lock-in period of 5 years or 8 years, whatever it is. And you will be compensated every year for some interest. And at the time of redemption, the return that will accrue to you will be dependent on the gold price that was there at that point of time. So for example, you have invested 50,000 rupees in sovereign gold bonds. On the date when you invested, gold was having a value of 5,000 rupees per gram. Okay, fine. So you invested. You will get 2.5% interest also per annum. Okay. At the end of the life of the bond, 8 saal beat gaye, you held up till maturity. At the end of the life, you are going to get, suppose the price is 8,000 per gram. पहुंच सकता है. Looking at the way gold is increasing, वो 8,000 जल्दी पहुंच जाएगा. So you are going to get 80,000 rupees return. Okay, so this is your invested amount and this is the redemption value. Okay, so now I want you to tell me RBI sovereign gold bonds, SGBs. Do you think they pass the CCFC test? Do you think they pass the CCFC test? Before that, are they financial assets? Are they financial assets? You don't get gold in return. What you get is compensation linked to the gold price. Okay. So be clear about that. You don't get gold, but you get compensation. That means your return of principal will be linked to the gold price. Is it a financial asset? Answer is yes, it is a financial asset. Now I want you to tell me, does it pass the CCFC test? Does it pass the CCFC test? Does it pass the CCFC test? We'll come to that later. Okay. Yeah. Derivative, accounting, etc. Forget that. वो बाद में देखेंगे. Okay. It is because there is a right to receive cash. So that meets the definition of financial asset. Absolutely right. Does it pass the CCFC test or SPPI test? Principal and interest will be received. Okay, what about the others? Tushar. And who else is there? Today, very few people. Viraj, what do you think? Are you there? Yes. Come on, tell me. Okay. I'll come to that. Why we need to do this test, I will come to that. First, you understand the test. Then we need to do one more test. And then I can explain why you need to do both the tests. Okay. Okay. Again, we go to the story of the village lender. Okay. Again, we go to the village lender. We need money for something. So we ask him to lend us money. He will say, you will have to pay me principal based on gold prices. Will you agree to that? He will say, you will have to pay me the principal depending on the inflation in the gold prices. Will you agree to that? Or will you say, listen, whatever is the amount, take your interest, take your principal. I don't want to pay 1 paisa extra or 1 paisa below. Will you say this or will you accept it in a basic lending arrangement? What do you think? Will you accept repayment based on some index? Will you accept inflation? Will you accept gold priced inflation for repayment of your principal? You will not accept. So that means you only have answered the question, does it meet the requirement of a basic lending arrangement? Answer is no, it doesn't. It meets the requirement of a basic lending arrangement when the principal folds back to you as it is, and the interest is defined based on inflation, credit risk, profit margin, sum total of these three. When your gold price, you link it to a commodity. When the principal return, you start linking it to a commodity, it is not going to be a basic lending arrangement. It will in some manner amount to speculation, because you are putting bets against the rising price of the gold. And a normal credit lender will never do that. A normal credit giver will never do that. He will say, I need my principal, I need my interest, uske zyada kuch nahi chahiye. If he asks, nobody will pay it, because it is not a basic lending arrangement. It is not a basic lending arrangement. And therefore, do RBI sovereign gold bonds meet the CCFC test? Answer is unfortunately no, they don't meet the CCFC test. Because when you lend money to the RBI in the form of sovereign gold bonds, what you are getting back is linked to gold prices. And that is not a basic lending arrangement. Somewhere you have an interest in the price of the gold and not in the return of the principal. Okay, somewhere you are saying that gold price is increasing so much, so it is better that I invest in sovereign gold bonds. Your interest is not only principal and interest return. Your interest is matching the return that gold is generating on account of the high price movement which is happening currently. And therefore, when you lend money to RBI in the form of sovereign gold bonds, it does not pass the CCFC test. It does not pass the SPPI test, because you are ending up not meeting the basic lending arrangement. You are ending up not meeting the basic lending arrangement. It is a financial instrument. I'm not denying that. It is a financial asset. That also I'm not denying. Okay. But it does not pass the CCFC test. It does not pass the CCFC test. Okay. All right. Did you follow? Did you understand the CCFC test? Yes. Did you understand the CCFC test, everyone? So the first question that you will ask is the CCFC test met? Did you pass the CCFC test? Okay. Okay. Agreed? All right. And after that, the second test that you will do, if CCFC test is passed, CCFC या फिर नाम बोलो SPPI test. Okay. If you pass this test, you will have to perform a second test. You will have to perform a second test. Which test? Business model test. Which test are you going to follow? Are you going to perform? Sir, I will be performing the business model test. I will be performing the business model test. Now, what do you mean by business model test? Acha, these tests, CCFC business model, apply only for financial assets. Okay. Don't apply it for financial liabilities or equity. So if your instrument is a financial liability for you, don't even check CCFC and business model. You will only check it for financial assets. That's it. Okay. So if the CCFC test is passed, you check the business model test. Okay. Now, what do you mean by business model test? What do you mean by business model test? Okay. Business model test is going to be a test of how you are managing your portfolio of assets. Okay. It is a thought process of how the financial assets of the entity are being managed. So what is your business model test? It is basically a thought process. A thought process of what? Of how the portfolio of financial assets are being managed. Okay. So what does it mean, thought process of how the portfolio of financial assets are being managed? Please elaborate. Okay. So let us assume that you have two banks. Okay. One is Canara Bank and one is ICICI Bank. Okay. Two banks are there. Banks mein what is the job? Collect money from the deposit holders and give it to the borrowers. The difference in interest rate is what is the profit that is being made. Okay. So you have two banks, Canara Bank and ICICI Bank. These banks will collect money from deposit holders. Okay. They collected the money. Now the next question is, do you think they can lend the entire money what they collected to the outsiders? Answer is no, they cannot. Why? Because kal ko ut ke depositor aage give me my money back. What do you think these banks will do? Do you think they will chase their lender? That borrower is, that deposit holder is asking the money. So you please give the money so that I can give it back to the deposit holder. Do you think banks can do this? Answer is no, they cannot. RBI has prescribed that they should maintain a liquidity reserve. They should maintain a particular liquidity reserve at any point of time, so that in case the deposit holders come, the bank is having cash to immediately refund the deposit holders. So we call that as SLR. SLR means what? Statutory liquidity ratio. This is an example. You don't have to remember this. You call it as a statutory liquidity ratio, SLR. Okay. And then you have CRR, whatever, many reserves are there. So this is currently 18% of deposits. Currently, this is 18% of deposits. Okay. What do I do with this SLR? The bank, suppose it receives 10,000 crores of deposits. 10,000 crore is huge money. Huge money. It is very, very huge. Okay. So 10,000 crores of deposits it receives. Out of that, 18% is going to be invested. So 1,800 crores will be invested. 1,800 crores is your SLR. Okay. What do you mean by SLR? This amount should be readily convertible into cash. This amount should be readily convertible to cash at any point of time. So basis that, you can make your investments. You can make your investments. So what Canara Bank does is, SLR hai na, let us take bonds, let us take government securities, and let us put this 1,800 crores in government securities. हम लोग उसको monitor नहीं करेंगे. We will not monitor this 1,800 crores. वो पड़ा रहेगा किसी investment में. जब investment mature होगा, it will fall back into our account. Then again we will invest. Okay. But those are specified investments readily convertible to cash. SLR has given the required investments, the required portfolio where you have to make the investments. So what you will do is, you will invest the money in those bonds. Invest money in bonds, securities as mandated. And then बैठ जाओ. Okay, you will invest and बैठ जाओ. अपने आप interest is coming, then on maturity principal is coming, again gets reinvested, again interest will come, again maturity will come, again gets invested. Okay, so it goes on getting invested, reinvested, collect interest, collect principal, reinvest. जब कस्टमर आएगा यू विल पे इट ऑफ, अगेन डिपॉजिट आएगा, यू विल इन्वेस्ट, कलेक्ट प्रिंसिपल, कलेक्ट इंटरेस्ट. सो कैन आई से दैट कैनरा बैंक हैज अ मॉडल ऑफ hold to collect? Yes or no? Hold to collect contractual cash flows. Can I say that this is the model of Canara Bank? Yes or no? I'll give a break. I'll just finish this part and give a break. Okay. Can I say that Canara Bank has a business model of holding to collect the contractual cash flows? Contractual cash flows being principal and interest. So can I say that as far as the portfolio of statutory liquidity ratio of 1800 crores is concerned, can I say that the business model is only collecting the contractual cash flows? और कुछ भी नहीं है. You got the deposit, put it in SLR, and then you collect the interest, collect the principal, redemption happens, falls back into your account, or managing it. I will just be very quiet, and whatever happens, thoda moda return milta hai, it's again getting paid off. I don't have to do anything. So this is a very passive form of investing. I'm not saying it's wrong, but this is how Canara Bank is doing. As compared to that, let us look at ICICI Bank. As compared to that, let us look at ICICI. This also invests money in bonds or securities as mandated. Yes, but the thing is, what ICICI's investment and portfolio department does is, each security where it has invested, it will track the price movement, it will track the bond yield, it will track the yield to maturity, and basis the each investment analysis that it does, they will come to a conclusion whether to hold this investment or whether to dispose of this investment right now or later. What do you want to do with it? Say that the business model is only hold to collect, or can I say that the business model is hold and sell? Hold and sell. Can I say that this is my business model for ICICI Bank? What do you guys think? What is the business model? What is the, are you only interested in collecting the contractual cash flows, or are you interested in selling the investments as and when a better price is received? And if you don't get a better price, you will continue to hold. What do you think? What do you think? Is it only held to collect contractual cash flows, or is it hold and sell? Is it hold and sell? ICICI Bank, what do you think is the business model? The bank says we are very active. We have an investment manager jiska yahi kaam hai. His work is only this. He will track the investments, recommendation for selling, ensures the sales happens, ensure it comes back to the entity. Okay. So therefore, this is another form of investment. So the business model is hold and sell. So these two are the broad business models that you are having. First model, held to collect. Second model is hold and sell your what you can say, hold and sell your portfolio. Both are okay. I mean, I'm not saying one is better than the other. nothing. Both are uh, perfectly fine. But the accounting of this starts to change. The accounting of this starts to change. Okay. So let us take a quick 5-minute break. It's 9:06. We resume at around 9 9:15 के आसपास will resume. Okay. So we will continue the discussion further. Okay. All right. Hello. All right. Welcome back. So let us continue. So we have understood in brief that we had two tests. One is the SPPI test, that is the contractual cash flow characteristics test, and the second one is the business model test. You will perform the business model test after the CCFC test only if you pass the CCFC test. Okay. So we took the example of Canara Bank as well as ICICI Bank. So when I say hold to collect contractual cash flows, we also call it by another name, that is the investments are held till maturity. The investments are held till maturity, HTM. Okay. If you are holding solely to collect the contractual cash flows, then we call it as investments held until maturity. Whereas if you have a model of collection as well as selling whenever the price is right, it is a normal hold and sell arrangement. There you are not holding it until maturity. There you are not holding it until maturity. Okay. Now, how do we evaluate this? How do we evaluate the business model? Is it evaluated on investment by investment basis, or is it on a business basis? It is obviously on a business basis. It is a very generic model. Okay. So you will suppose Canara Bank has a portfolio of 1800 crores. And suddenly there came a scenario where some deposit holders wanted to withdraw the money urgently. Okay. So like for example, if I recollect, there was a time when LIC employees initially they opted for getting the entire funds back on retirement instead of the pension plans. So they were not getting pension, they got all the funds back. Because at that point of time, in between somewhere maybe 10 years back or 15 years back, the interest rates were touching almost 10%. So they thought that, yaar, pension se acha, let us put the money back into fixed deposits. We will end up earning more. So what these people did was, these LIC employees, most of them, they took back all the funds that were there, the employment funds that were saved in their name. They got it back and they put it in fixed deposits and they were getting money back. But what happened thereafter is, interest rates went on coming down. It came to 6%, 5%. And then suddenly these people were left high and dry. Now pension hai, neither do they have the proper interest rate. So they felt kind of, yaar ye kya hai? We made a wrong decision. So they wrote to the finance minister, LIC union went to the finance minister, and finally they got the pension scheme reinstated to them. But for reinstating the pension scheme, they had to make a deposit amount back, because pension kahan se aata hai? From the money that is deposited there with the government, right? So thousands of LIC employees went to the bank, exercised the option to prematurely withdraw the deposits, and they gave it to LIC and got the pension scheme reinstated. Now thousands of depositors went to the bank. So let us take that those thousands of depositors went to Canara Bank, and Canara Bank had at the most 3 to 4 crores readily available. But the people who came for getting the deposits back, the total value of those deposits was 10 crores. 3 crores were met out of the usual deposits which were there. The remaining 1800 crores were for held to maturity. Now, when you have 7 to 8 crores deficit you have to pay, can you tell them, my investments are maturing after a week, so please come after a week? Can you say that? वो depositor बोलेगा मैं क्या करूँ? It is my money. It is deposits repayable on demand, and therefore you please give the money back to me. So Canara Bank now has to go and break its SLR and sell the portfolio equivalent to 7 to 8 crores to meet the requirement of these depositors. Is it okay? So now look at it. I have a deposit value of 1800 crores, I had to sell roughly about 8 to 10 crores. I did not meet the, these 7 to 10 crores did not have the bandwidth of time for maturing and then paying off. Depositors wanted it urgently. So I had to sell those 7 to 8 crores. So now I want you to tell me, do you think that merely selling 7 to 10 crores out of 1800 crores, will it change my business model? Will it change my business model? क्या लगता है आपको? What is my business model? My business model is held to maturity. But what did I do? I sold off about 10 crores. Why did you do so? Because sudden inflow of depositors. They wanted money urgently, and therefore हमने क्या कर दिया? We sold some instruments, got the cash and paid the depositors. So now I want you to tell me, think and tell me, is my business model changed? देखो, 1800 crores, 10 crores sold. So I'm left with 1790 crores. My question is, the business model in respect of these 1790 crores, is it held to collect or is it still held to maturity? Are obvious, is it held to collect and sell or HTM? It is obviously held to maturity. 10 crore आपने बेचा, वो ठीक है. What is the percentage? What is the materiality? Why do you break your head so much? You will look at this 1790 crores versus this 1800 crores. They are still held to maturity, and therefore business model has not changed. The business model has not changed. It continues to be held to maturity. It continues to be held to maturity. Okay. So you are collecting the cash flows. You are collecting the cash flows. There may be couple of occasions where you may have to sell them. That does not say that mere sale of 10 crores will not change the business model of 1790 crore. So therefore, at that point of time, kya hoga? At that point of time, you will have to take it as same business model continues. You will have to take it as same business model continues. Okay. Now, let us move further. Let us move further. We will not go ahead with a stressed situation. We will not consider stressed situations. Okay, let us take an example, a very recent one in fact, but utna bekar bhi nahi hua. In our example, things will be fine. You remember there was this SVB bank in the United States, jiska insolvent ho gaya wo. There was a bank known as SVB in the United States. वो मतलब SVB बैंक filed for insolvency. क्यों insolvent हो गया वो? Why did it become insolvent? Reason is simple. See, SVB bank had certain deposits. Okay, SVB bank had certain deposits. The deposits on SVB bank were generating interest in the range of 2 to 3%. US में उतना ही interest चलता है. Okay. So 2 to 3% interest on deposits. Okay. Because of inflation, what did the Fed do? Fed is like our RBI. Okay. Fed is like our RBI. Okay. RBI ने क्या किया? What did the Fed do? Fed started increasing the interest rates. Fed started increasing the interest rates. SVB is a private one. Fed means the government. So what people started doing is they started moving deposits from here and ultimately started investing in the Fed, because Fed wanted to control inflation. The way you can control inflation is by removing cash from the people's pockets. So what did it do? The Fed increased the interest rates. With the increase in interest rates, people started finding that private banks were not so attractive as the government. So they started to pull the money from private banks and they went to the Fed to invest there. Now, all this huge rush of depositors created a run in on deposits. Okay. Run in on deposits means what? Suddenly, all your deposit holders came to the bank and say, mere ko mera deposit de do, I will invest somewhere. Can you tell the depositors not to do that? Answer is no, you cannot. Why? because it is their right and it is their money. They can demand it. Okay. But the problem now happens is, do you have the funds to pay this off? Do you have the funds to pay them? Ultimately, आपका cash, उनका cash आपके पास cash form में नहीं रहता है ना. It's not in cash form. You would have given to other borrowers and you would have given to statutory liquidity ratio also. You cannot call the borrowers and say, give the money back, I have to give the depositors, because with the borrowers you have mortgage loans which run into 10 years, 12 years, 15, 25 years. They will not be in a position to pay you. But you have to pay the deposit holders because it's mandated on you to do that. But unfortunately, if you stick to the hold to maturity model, then you cannot pay the deposit holders. Okay. So SVB Bank had to seek the help of US Fed to ensure that it retained its position. But in our example, itna bekar hal bhi nahi hai. Okay. In our theoretical example that we saw, SVB Bank had 1800 crores. The sudden inflow of deposits ensured that 1500 crores of deposits had to be paid back. Okay. Now out of 1800, the bank is constrained to sell 1500 crores. That means what? Is it selling a majority chunk? Definitely. Not only more than 900. You can say that 600 crores the bank decided to sell. Is 600 significant? Definitely it is significant. So now the question arises, is your business model changing? The question that now arises is there a material change in the sale of deposits? Yes, you were managing the portfolio with a held to maturity model. Now you are forced to sell the deposits to pay the deposit holders. And therefore, can you now say that my business model has changed? Answer again is you cannot, because this is a stressed period. This is a stressed scenario. This is not a regular scenario. And because this is not a regular scenario, you cannot say that the business model has changed. You cannot say that the business model has changed. Is it okay? So you will consider business model change when there is a change in the normal course of business. If the change happens in a worst case scenario, that is not going to decide what is your business model. Is it okay? Have you understood this part? Yes. Did you understand the business model? Did you understand the business models? Yes, two business models are there. Okay. All right. Aage badhe. Shall we proceed further? Shall we proceed? Anybody, any doubts? Janvi, Namrata, you guys there, are you able to follow? Yes. All clear? Okay, fine. So now let us then move on to the next part. Okay, let us then move on. We did two tests. SPPI test humne kiya. We passed the SPPI test. Okay, let us take one more example. Let us take one more example. Debtors. What do you think will be the business model for debtors? Does it pass the SPPI test? Answer is yes. So now you do the business model test. I will summarize it. In fact, your study material has summarized it. We are going to visit that just in a while. Debtors passes the SPPI test. What do you think will be the business model in the case of a portfolio of trade receivables? Do you think it will be held to maturity, or can it be held to collect and sell when required? What will be the held to maturity? Business model में pass fail नहीं होता है. Okay. See, if it is a financial asset, you will perform SPPI test. If SPPI test fails, then there is some accounting prescribed. If SPPI test pass, you will do the business model test. Business model test, there is no pass and fail. Business model test, there is no pass and fail. Business model test fits into two. Held to maturity or held to sell and collect. Okay, not it will be, one second please. Held to collect and sell as required. These are the two business models. In business model, there is no pass or fail. Okay. So for an instrument that meets the SPPI test, you have two business models. One of them you will typically fall into. So now you tell me what is going to be the business model for a portfolio of debtors. Did I pass the SPPI test? Answer is yes. So you will check the business model test. What do you think will generally be the business model test for trade receivables? Most of the cases, it will be held to maturity. Held to maturity क्यों होगा? You will wait till the credit period gets over. तब तक आपके trade receivables आपके account में आ जाएंगे. Yes or no? Sell means not the sales, not sale of goods which gave rise to debtors. Hold and sell, I am going to explain just a short while from now. But held to maturity in a debtors arrangement is what? You make a credit sale. The credit sale gives rise to trade receivables. The trade receivables are a financial asset. The financial asset meets the SPPI requirement. The business model will be, you will wait for the trade receivable to pay the money back to you. That means on the maturity date, when the credit period ends, automatically your trade receivable will pay the money into your bank account. So that asset is getting matured at the end of the credit period. So the most common business model in the case of trade receivables is held to maturity. But do I have a holding for collection as well as sale possible? Definitely. Suppose I have a portfolio of trade receivables where I am seated, I have my office, my plant situated in, let us assume in Delhi, and the plant is in a very remote location somewhere down south. Okay. Let us assume you have a plant in Salem. Okay. Now, it is very difficult for you, the Delhi plant, to manage the trade receivables in Salem in Tamil Nadu. So what you do is you will sell the trade receivables to a factor in Salem. You will sell the trade receivables to a factor in Salem. What this fellow will do, the factor will pay the money to you immediately, and it is the factor's responsibility to ensure collection of the money, as well as he will keep the proceeds with himself. Because he's paying you urgently, immediately, he will charge some commission, some interest, but ultimately, what you are doing, are you going to get the money from the trade receivables? Answer is no. You sold that portfolio to the factor paid you the money. So now the trade receivable is going to pay the money to the factor. Is it okay? Have you understood? तो इसको हम लोग बोलते हैं held for collection as well as sale as and when required. So if this is done for quite a number of times, it ends up becoming a common business feature and a part of your business model तो इसको हम लोग बोलते हैं hold to collect as well as sell when required, and the other one is held to maturity. Now, why do I do these tests? Okay, see, if I hold to maturity, what is my intention? I want to be passive. I want to just enjoy the interest income which is coming, and I just want to ensure my principal is not suffering. So therefore, do you think the fair value of this financial asset will matter over here? Do you think the fair value of the financial asset will matter in this case? For an entity with held to maturity business model, for an entity with held to maturity business model, do you think that fair value matters? or do you think that fair value का कोई संबंध नहीं है? They are mainly concerned with collecting the cash flows and collecting the principal. So do you think fair value matters in the case of held to maturity business model? Do you think fair value matters in the case of held for maturity business model? क्या लगता है आपको? Does not matter. Suppose you have invested in a fixed deposit in a bank. Do you really care about what is the fair value of that deposit? Or will you say that, yeah, principal is coming and my interest is coming. Why should I do the fair valuation of that? I'm happy with what comes in. And therefore, will you actually be worried about fair value? Answer is no. So here, fair value does not matter. And because the fair value does not matter, you will go for amortized cost accounting. What is the accounting? I will tell you. Okay, that is what will be our discussion tomorrow or day after. But because the fair value does not matter, you will have a scenario where I will not look at the fair value only. Because my business model does not require it. My business model is collecting till, is holding till maturity. After maturity, I get the money. I again put in investments. I wait till their maturity and then I will collect it. So fair value का तो कहीं पे जिक्र ही नहीं है. There is no need only for fair valuations, and therefore we will be following amortized cost model of accounting. Okay, amortized cost means what? It's basically principal plus interest minus repayments closing balance. That is what is simple language amortized cost. Basically opening plus interest minus repayments gives you closing. So that is what is your amortized cost. Coming to the next one, held to collect and sell as required. Do you think fair value matters here? 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 You are holding to collect the cash flows, and whenever you find that price is right to sell, you can sell it off. So do you think fair value matters here? Yes, here the fair value matters, and that is why typically we follow the fair value through other comprehensive income here. Okay, typically we take the FVOCI route in the case of these instruments. Is it okay? Yes, are you able to follow? Yes or no? So now coming back to our discussion. Yes. Okay. All right. So fair value matters. So we take the fair valuation route. Okay. So now coming back to our discussion कि भैया सर आपने हमें CCFC test बताया, business model test बताया. You have told us all this. So now where do we get to see this? Okay. So I have told you business model test. It is a business model for managing financial assets. Okay. Not determined by a single factor or activity. Okay. So just go through this. This is for your information. It's not extremely important from exam perspective. Accounting is very important, but your business model and all, just for the sake of reading, you can do it. Okay. How do you aggregate? Okay, determined at a level that reflects how groups of financial assets are managed together. Okay, determining the basis of realization, whether it is from collecting contractual cash flows or from selling financial assets or both. Okay, all right. Difference in actual realization from business model. Okay, so it does not give rise to a prior period error. We told you change in the sudden run in on deposits you had to sell, so it will not change the classification. Okay, there won't be any change. So that is what we have already discussed. Okay. Now let us come to the next part. I have also discussed with you contractual cash flows characteristics test, CCFC. Okay. CCFC test. Principal is the fair value at recognition. We'll see that now. Okay. Principal may change on account of repayments. Components of interest in a basic lending arrangement, time value of money, that is inflation. Credit risk is also there, but there could be other items also, like for example, liquidity risk, you have told me already. Costs could be there, like processing costs, administration fee, etc. Profit margin we have covered. Okay. Interest could be negative in extreme economic circumstances. So anyways, that is not what we get to see here. Okay. Contractual terms that introduce exposure to risks or volatility in the contractual cash flows unrelated to a basic lending arrangement, such as exposure to changes in equity prices or commodity prices. I gave you the example of sovereign gold bonds. So they do not give rise to contractual cash flows that are solely payments of principal and interest. I gave you this example also. So we have studied this, is what I want to tell you. Okay. So basically the theory part we have discussed. The theory part we have discussed. And now we come to the actual measurement of financial assets. Okay. So now with the help of the SPPI test and the business model test, you will now be able to appreciate this chart in a very what you can say, in a very comprehensive manner. Okay. So what is amortized cost? We will see that. But when are you going to follow amortized cost? Sir, I will follow amortized cost when the below conditions are met. What are the below conditions? Financial asset is held with the business model whose objective is to hold financial assets in order to collect contractual cash flows. So this is important. Business model whose objective is to collect contractual cash flows, whose objective is to collect contractual cash flows. Okay. So that is exactly what they have mentioned. Hold financial assets in order to collect. So इसको हम लोग बोलते हैं HTM, hold to maturity. Contractual terms give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. So this is SPPI. This is SPPI. So first one is held to maturity. Second is SPPI. If you meet both these, then you will be measuring the instrument at what? Amortized cost. And what is amortized cost? Principal plus interest minus repayment. Principal plus interest minus repayment is equal to your amortized cost. That's it. Simple accounting. कोई टेंशन नहीं, nothing complicated, same simple accounting that you used to do earlier. Okay. However, if you are having financial assets with business model whose objective is achieved both by collecting as well as selling financial assets, so CCFC test is also fulfilled, plus selling the financial assets. In our example, ICICI Bank, it was active as an investor. It was active as an investor, and therefore they were doing the accounting. Their business model was collecting cash flows plus selling financial assets. And finally, contractual terms give rise to cash flows that are solely in the nature of principal and interest. So here also SPPI needs to be met. So if that is the case, don't look at the last part. Last part I'm going to come just now. Fair value through other comprehensive income. You will take it as FVT OCI. Is it okay? Did you understand? Yes. So identifying whether it is a financial instrument, identifying whether it is a financial asset, identifying what is going to be the business, what is the, whether the CCFC test is followed, whether the what is the business model test. After all these steps, you will come to the decision on accounting that it could either be amortized cost or it could be FVT OCI. Is it okay? Did you guys follow? Yes. Any doubts so far? Any doubts? No doubts? All clear? Yes? Okay, fine. So now coming to the last one, FVTPL. What is not amortized cost, what is not FVTOCI will go and sit under FVTPL, will go and sit under FVTPL. That is how they have defined it. Any asset which is not measured at amortized cost, not measured at FVTOCI will be accounted at FVTPL, will be accounted as fair value through profit or loss. Is it okay? Did you follow? Yes? Yes? Okay. Now, I am left to discuss with you two paragraphs, these two. Okay. That should take care of the entire chart and then we can start off with the accounting. Is it okay? Yes. Did you understand? Yes. SPPI test is not passed. If SPPI test is not passed, straight away come to this one. FVTPL. See, you will check SPPI test is passed here. SPPI test is passed here. So FVTOCI or amortized cost. Any asset which is not measured at amortized cost means what? It may not pass the SPPI test. And if it doesn't pass SPPI test, you cannot follow amortized cost. For example, investment in equity shares. Do you think, okay, suppose you are holding investment in Reliance Industries Limited. Chalo, batao. Does it pass the SPPI test? Does it pass the SPPI test? You are holding investment in equity shares of Reliance Industries. Do you think it passes the SPPI test? Do you think investment in Reliance passes the SPPI test? Sir, क्या आपने प्रिंसिपल पे किया? नहीं, मैंने कोई प्रिंसिपल पे नहीं किया. I just purchased the share. Okay. कोई interest का repayment? Answer again to that is no. Okay. So nothing is there in what you can say. Nothing is there that suggests that you pass the SPPI test. Is dividend mandatory to be declared? Answer is no. Is return of principal mandatory? Answer is no. So therefore, do you have a contractual cash flow? Answer is no. So will you pass the SPPI test? Answer to that is a resounding no. And therefore, amortized cost is gone out. FVT OCI is gone out. So therefore, you are only left with fair value through profit or loss account because it says other than amortized cost and other than FVT OCI. Is it okay? Yes? Sure. Did you follow? Any doubts? Anyone so far? Come on, guys, please revert. It's getting technical now. So therefore, I need your attention, please. Yes. Anybody, any doubts? No doubts? Namrata, Jahnavi, Tushar, Viraj. No doubts. Okay. Yes. All clear, everyone? All right. So now with this today's session, we shall conclude here only, because the next part, what is there, it is fairly, large, and I don't want it to, because if I start now, I'll not be able to even introduce it properly. Okay, so we shall pick up the next session on the accounting of these assets in the next class. Okay, and once that is done, let us see. So just ensure that maybe tomorrow, day after, and Sunday, you keep a laptop with you or a desktop with you, because I may end up solving questions on Excel, just so that we can save the time. Okay, so if possible for you, please ensure that you keep a laptop or desktop at the side of you. Okay, so that takes care of today's class. Thank you, everyone. Please share your feedback with the institute. Okay, these are standards which are typically complex. Okay, so please share your feedback with the institute if anything is there, and if anything I need to improve, please let me know. If I'm too fast, too slow, okay, so, or if you're not clear, that also you can share with me. Okay, all right then. Chalo, that takes care. Thank you, everyone. Okay, thank you and take care.